to the Masters Advisors Financial Foundations webinar series, where we cover a broad range of financial topics, including taxes, investments, cash flow planning, and risk management. Today, we're going to talk about investments. So I love this slide. I think this slide does a great job of illustrating a pretty important topic when we approach investments, and that is to focus our energy over on those factors over which we have control. And as you can see on the slide, it's the upper left-hand column here of the sphere, which is the amount we're saving versus the amount we're spending, and where we're putting our dollars, how we're allocating them, and where we're sitting them. It's also important to understand those factors over which we do not have control. And as you can see on the screen, that it does include the big one, which is the stock market returns. We have no control over what the stock market does. So it's more useful to focus our energy and our attention and our emotions on those factors over which we do have control. I want to talk first about the power of compounding. This is a very foundational item that's very important to understand as it relates to investments. I'll go through a couple of slides to talk about this. This chart, it's relatively small, but I do want to try to talk through what this chart is. You'll notice I'm going to draw your attention to the person in purple, who in this example is named Lila, and the person in gray just below, which is named Quincy. Lila started investing at age 35. She invested $200 a month from age 35 to age 65, so 30 years of investing, $200 a month, and earned 6.25% interest, average annual rate of return. In contrast, Quincy started 10 years earlier than Lila. He started investing $200 a month, same as Lila. He earned the exact same rate of return, 6.25%. However, Quincy started 10 years earlier at age 25, and he stopped adding money at age 35. He only invested for 10 years. Lila invested for 3 times the amount of time and added 3 times the amount of money as Quincy did. Yet at age 65, they both, in this example, wound up with roughly the same amount invested. Why is that? That is the power of compounding. This chart does a really good job of showing why compounding is so valuable. In this chart, you'll notice that the money that was added, in this example, it shows some money being added from an employee and some money being added from an employer in a retirement plan. Those are the shades of purple at the bottom. The gray shade is how those dollars, the compound interest earned on those dollars. And you'll notice that it gets very, very large after about 20 to 30 years. The amount of compound interest earned on those dollars is significant. So the earlier you start investing, the more you can leverage the power of compound interest. This chart does a nice job of giving you an example of, based on the amount of income you're looking to replace in retirement and your age when you begin investing, how much, generally speaking, you should target as far as a savings rate for the future. So an example, if you're looking to replace a $60,000 a year income and you are 25, this chart says that likely your savings rate should be about 6%. If you wait 10 years, that savings rate should be about 10%. If you wait 20 years, your savings rate triples to about 19% according to this chart. A couple of points here. First, the earlier you start, the better, and it's never too late to start. Next section we'll talk about is a couple of items you maybe have heard of before, and that is risk tolerance and time horizon for investments and how those things impact the decisions you should be making on investing. This chart is by a gentleman by the name of Carl Richards. It comes out of his book called Behavior Gap, and it does a very nice job of illustrating one of the principles of investing, and that is the future is inherently uncertain. The farther out into the future we're planning for, the more uncertainty there is. And that's just something that we all have to grapple with when it comes to investing and get comfortable with, the uncertainty of it. So as a result of that, that uncertainty does inform what we should be doing with our money based on when we need to use it. So those goals that are shorter term in nature, any money we've set aside for shorter term things like emergency funds or an expense coming up in the next couple of years, those should be set aside in cash. Even though it's boring, not very exciting, over the short term, investments, stocks, bonds, they fluctuate. And it's not a wise idea to invest money that you need for an emergency fund or for an expense that's coming up in the next couple of years. However, the farther into the future your goal is, the more investment risk can and should be considered for the money. So you can see on the screen here a longer term goal, which is defined as something north of 10 years, 10, 20 years, even more into the future. Equity risk should be considered, can be considered for those types of goals. Now, a couple of things when you're looking to invest money that's important to think about. First is risk tolerance. Each one of us has a tolerance for investment risk, and someone with a high tolerance will be more willing and able to accept the fluctuations in the stock market. Someone with a lower tolerance for investment risk will be less willing and able to accept those fluctuations in the stock market. So the person with a higher tolerance for risk can generally afford to take a little bit more investment risk than someone with a lower tolerance for risk. However, what's very, very important to consider when it comes to investing money is your time horizon. The more years you have until you need to use the money, the more investment risk you can generally take, all within the confines of your risk tolerance. Now, this chart does a nice job of illustrating what we're talking about here. So this chart shows the annual total returns for over the last 72 years, from 1950 to 2022. And I think it's most helpful to focus your energy in on the columns in green. So the column in green represents the range of annual returns in the stock market during that period of time. And you can see the range is significant. The worst performance over that period of time was a loss of 39%, the best performance 47%. So over a 1 year period of time. That's why we say any money you need for an emergency fund or a short-term goal, you do not want to invest that money because the market from year to year swings wildly. However, you'll notice the farther out you go, 5, 10, 20 years, the range of outcomes that have been realized over the 72-year period does tighten up a bit. So looking at the 20-year time frame from 1950 to 2022, the lowest rolling 20-year rate of return for an all-stock portfolio, the S&P 500 in this case, was a 6% rate of return. The highest was 17%. So you can see that the farther out you're looking to plan and invest for, the more you can consider equity risk within the confines of your risk tolerance. Next section is on investment accounts, and there are different types. We often get questions on whether someone should be investing on a pre-tax basis or a Roth basis. So we'll talk about that here today. Now, I want to draw your attention on this chart to the top two. You'll notice pre-tax retirement savings and Roth retirement savings, the differences between them. You'll notice that they both have tax deferred investment growth, but the differences are on when you pay the tax. So for pre-tax retirement savings, you're getting a tax break on your contributions. And as a result of that, when you go to withdraw money from the account, all of that money is subject to income tax when you withdraw it. In contrast, Roth retirement savings, you're not getting a tax deduction on your contributions. However, when you go to withdraw the money in a qualified withdrawal in retirement, generally that money is tax-free, all of it, when you withdraw it. So this is an important distinguishing characteristic between pre-tax and Roth retirement savings when you want to pay the tax. Do you want to pay it now, or do you want to pay it in retirement? So some guidelines. This chart is just a general rule of thumb, a couple of caveats to it, but a general rule of thumb on whether you should consider Roth retirement savings or pre-tax retirement savings, or a little bit of both. And you'll notice here that the younger you are and the lower your income, the more Roth retirement savings should be considered. The older that you are, and especially the higher your income, the more pre-tax retirement savings should be considered. A couple of notes here. This column, these income figures are for married folks that file a joint tax return. If you're a single individual filing singly, then you'll divide these income numbers in half. Final section here is going to be on market timing and investment diversification. So this chart does a nice job of illustrating the dangers of trying to time the stock market. Couple of things here. Column on the far left is someone that stayed fully invested over a 20-year time frame between January of 2002 and December of 2021. 20-year time frame. Couple of points here. 7 of the 10 best days in the stock market during that period of time occurred within 10 days of, within 2 weeks of the 10 worst days in the stock market during that same time frame. So trying to time the market is a very dangerous game. And as you can see, someone that stayed fully invested during that 20-year time frame could have realized an average annual rate of return of 9.5%. So if they invested $10,000 in January of 2002, and at the end of 2021, they maybe would have had a balance of about $61,000. If that person tried to time the market and missed the 10 best days in the market, that cut their return almost in half. So trying to time the market, you run the risk of missing out on some good days, because the market moves significantly from day to day, week to week, month to month, year to year. Trying to time the market is generally a loser's game. So staying fully invested is generally a better way to go. So how to approach investing? A couple of points here. First, it's a better plan to invest in regular intervals. Do not try to time the market. So investing, commit to an investment plan, figure out what you want to be investing, what you need to be investing to fulfill your goals, to meet your goals, and do that in regular intervals. Be aware of your emotions and how they can influence your behavior and your thoughts. Warren Buffett, the very famous investor, said this: be fearful when others are greedy, and greedy when others are fearful. Now, that can be difficult to do. The news media is going to obviously make headlines when things get scary, and it's going to cause us to want to do the opposite of what we know we should do. It's going to cause us to want to get out of the market when things get scary. So best thing you can do is just commit to an investment strategy that fits your tolerance for investment risk and your time horizon, and continue on with that investment strategy, investing in regular intervals. Now, it's also very important to maintain proper diversification in your portfolio. It can be very, very tempting to have more money than you should tied up in your favorite company or your favorite sector. Maybe you work in a particular sector and you're more comfortable with it. Or maybe you have a particular affinity for a publicly traded company, or your employer happens to be publicly traded. You want to guard against the temptation of putting too much money in a particular sector that's in vogue, or that you like, or a particular company, because having too much concentration in one particular sector or company exposes you to excessive risk. You want to stay diversified. You want to stay diversified globally. Also guard against the temptation to have your portfolio concentrated in one particular country. You want to maintain appropriate global diversification. This chart explains why. You'll notice that across the top are different years, 2008 to 2022. And the chart is sorted from top to bottom on what asset category performed the best in that particular year. And you'll notice this chart is a jumbled mess. It means that it's very difficult, it's impossible for one particular asset class to remain on the top for more than a handful of years. It's very, very difficult to predict from one year to the next what asset class is going to outperform. So it's a better strategy to maintain a balanced exposure to all those asset classes. That concludes our presentation on investments. Stay tuned for our other webinar series on cash flow, risk management, and taxes. Thank you.